Yo, my friends. What's good? What's happening? Episode 3 of 2J's stock reviews, or even if they are episodes, I don't know. But with the next finance video, we're going to do something a little different than stocks. I'm going to switch it up. I'm going to go to the personal finance avenue. But before we get there, we've got a third stock to review. So today, we're going to go over Smith and Wesson brands. Tickers SWBI. Smith and Wesson brands. If you live in America, most likely you know what Smith and Wesson is. Even if you're outside of America, you probably know what it is too. But regardless, Smith and Wesson is a gun manufacturer. They manufacture guns, handguns, rifles. Mostly handguns is where their name is synonymous with, to be honest. But they produce guns. They're, here aerospace and defense industrials is their classification. But today we're going to go into why this stock is a buy, okay? Currently we sit at $13.50 a share. You can see this is the max. Their IPO was in 2000s. They've been publicly traded for 20 years, and you see this is their graph, right? So it's went up, it's come down, it's went up, it's come down, and now we're sort of at a, moving average, whatever we want to call it, an average stock price over 23 years. I think we're at a solid spot for a buy in terms of the technicals, the chart. This is a dividend paying stock. Their dividend yields 4%. So per year, they pay 48 cents in dividends per share. So if you own 100 shares, you'd get paid, 48 bucks in a year in dividends. Something along those lines, my friends, right? So, to scroll on down, you can see over the past 5 years, the S&P 500 has beat this stock, which is normally not necessarily a good thing. You can see in the past year, though, Smith and Wesson has outbeat the S&P 500's return. If we go down here, usually dividend-paying stocks are positive earnings stocks. Like, a company's not going to be able to sustain a dividend without a net income, right? Because when a company has net income or a bottom line of positive, they have options, which we've talked about in a previous video, but they can reinvest back into the company. They can pay that out to shareholders as dividends. They can pay down debt, right? So there's some options with positive net income, a positive bottom line that they can do. This company chooses to pay out dividends, which normally means that the company considers itself at a pretty steady to stable growth rate, and they plan to consistently have a positive net income to be able to produce a dividend. They're like a cash cow company in a sense. They're paying you out a dividend for holding their stock, right? If we go down to the analyst targets, you can see the low is 14, the high is 20. We currently sit at about 13.50. Of the 3 analysts that cover this stock, 2 consider it a buy, 1 a hold. And you see here's the earnings estimate. So we just had the earnings did not go as well as they predicted in quarter 4 2023, which is sort of what alerted me to this stock. This is, the drop off right here, right up in here. So sort of alerted me to this stock, the fact that they've had a recent negative earnings call, but overall, this company is generating positive profits and meeting their earnings for the most part. I thought that $513 million in revenue and $30 million in net income was a pretty solid ratio for earning. And you can see total debt to equity is 27%. They don't have a lot of debt. So most of their company has been financed through equity or cash generated rather than debt, right? So that's super positive. If we move on to the financials, which is my fave, you'll sort of see why this company has fell off. So you see in 2020 into 21 and 22, they had some pretty high revenues, okay? And that revenue has sort of fell off. Trailing 12 months beats last year. Okay, so far, but relatively pretty stable. We're somewhere about the 500 million point in revenue. And the cost of revenue actually hasn't changed a ton. It's pretty stable, which is pretty positive for this company, right? So, their cost of revenue on a percentage basis stays relatively stable with income. So you can assume that won't move a lot unless their cost to generate weapons increases. You can see operating expense is going down. So when they're making less money, they've been able to reduce their operating expense. That's really a good management sign. It means management is aware of where their company's at and able to adjust. And you can see from operating, we've had positive. Looks like the past year we've took a bit of a dip, which explains the more recent dip in stock price, to be honest. But I think this is what makes this a buy, because I think the company will again put themselves back on a trend such as this based on the way that they used their money so far. But as you can see, for dividend stocks, this one's a really big category, right? Their earnings per share. Because if they're not earning enough per share in the company to pay out their current 48-cent per share in dividends, then they're not going to be able to sustain that dividend. So you would expect that the dividend won't continue to last in the future. So this is when you're reviewing dividend stocks, this is a really important key right here. You want to make sure that their earnings per share is greater than the amount that they're paying out in dividends, right? I mean, it seems simple in effect, but it's something to think about with dividend stocks, pretty much. Because if this begins to be less than the amount that they're paying out in share per dividends, you can expect that they'll slash the dividend or get rid of it entirely, which the market doesn't normally appreciate too well. You know, the market normally reacts very negatively to a company denouncing dividends or reducing dividends, right? If we scroll on down, EBITDA, positive. And like I said, for most dividend-paying companies, net income positive. You know, they had these really good years. You'd really like to see this trend back in a positive direction, right? But like I said, here on this next page, you'll really get a good look at how well this company is managing their money. You know, current assets and total liabilities, you know, pretty much 3.5 times the amount of assets and liabilities, and then current, we've got 1.5 times the amount of current assets over current liability. Really, about 3.5 times as well, to be fair, right? So about 3.5 times the amount of assets as liabilities, both on the total and the current category. We do have a lot of inventory in this company, and that's one of the areas that the amount of cash that was spent, if you notice, the cash drops about $70 million from 2022 to 2023. Inventory increases by about 40. And they also had some property, plant, and equipment investments. So you can see from 2022 to 23, net property, plant, and equipment went up by about $70 million in total. So they are investing into physical building, probably a distribution center or manufacturing plant to manufacture more guns, more ammunition, you know, whatever their plan is there. Haven't really read news into that. I just know that the company's cash that they generated, they're purchasing inventory, they're purchasing property, plant, and equipment, which will increase both the top line and bottom line, assuming the company manages their cash as they have, right? If you notice, in order to gain more inventory, in order to gain more property, plant, and equipment, we have not taken on more debt, which is supremely important. A lot of companies, individuals for that matter, we take on more debt for growth rather than producing actual cash flow assets to finance that growth, rather than asking. So instead of, you know, earning and saving the money to pay for it in cash, we're impatient and we want to ask, you know, the bank or the government for however much money we need. That's why I say this company does a very, very good job of managing their cash. You'll notice as they make more money, even in their best years, 21 and 22, their current debt completely stable, right? Completely stable. And their total stockholders' equity is stable and or climbing the past couple of years, which means debt is going down, right? Total assets has to equal total liabilities plus stockholders' equity. So if liabilities are going down, stockholders' equity will go up, right? Based on the formula, because the total assets, those two have to equal the total assets. Just sort of how the basic math of it right there, right? You know, working capital, really big measure for the company. I review this in every stock that I review. See, relatively stable. Super, super positive sign. So even though their revenue dropped off, you know, they had some really good years. 2021, you know, based on the income statement, right? So they had really, really good years here. Even though they had really good years there, their working capital even with revenue reducing, stays relatively stable in the ballpark of 200,000. We could say it's probably an average. So that's a really good sign of managing debt. You can see from 2020 to 2021, they had a lot of debt here. They made a bunch of money here. They reduced their debt by $150,000 or 150 million, correction. So another huge positive sign for cash management strategy. In my opinion, the management of this company has it going on like Donkey Kong, my friends. They're paying off debt. They're increasing their assets at a faster rate than they are their liabilities. I mean, it really does not get much better than that in terms of cash management, right? And I'm thinking and I'm hoping that we'll see that reflected in cash flow as well, how well they manage their cash, right? Total debt, like I said, goes down, stays relatively stable, which is a beautiful place to be, right? You really only want to see this debt increase if they're making major investments into the business, and they have. You could say 20 million of the total, was it 70 million increase in inventory and approximately 70 million increase in net property, plant, and equipment. Gives about 140 million increase in assets in the positive direction, and we only use $20 million from the bank to do that. The rest completely free cash flow generated from the business. It's a beautiful place to be. Management team smoking on this bad boy. Okay, last one, cash flow. As you can see, operating cash flow relatively stable. What I like to see is that our revenue was stable from 23 to the last trailing 12 months. Operating cash flow is higher. So they're figuring out how to cut their costs to a point. Another cash management sign that even with stable revenue, they're recognizing as management that their revenue went down from these years to these years, and they're able to use the money that they cut back on the money that they spend or other areas to generate a more positive operating cash flow. The investing cash flow is negative every single year. Honestly, this is a really big deal, right? This is a really big deal because investing cash flow being negative means that the company is investing into their business, right? They see growth available. I mean, you can see every year really stable investing cash flow until the trailing 12 months. Like I said, they've increased their inventory, increased their property, plant, and equipment. They probably built a new distribution center or manufacturing plant, and in that manufacturing plant have a lot more inventory than they had in the previous manufacturing plants, right? So this $117 million is what we've invested into the company. And financing, if you notice, we took, $35 million in debt to invest $117 million. I mean, like, cash management, huge. Cash management, huge, right? And I mean, capital expenditures, them being so high in the past 2 years, sort of explains the negative free cash flow. If you were to back out the amount they had invested in capital expenditures or into the company in general, the 117, you would, get back to a positive free cash flow of somewhere in the ballpark of their best years, which is a really good sign for the company. The only reason they don't have a positive free cash flow at the bottom like previous years is because they're investing. I'll add again that they've invested with free cash flow. They did not take on a ton of debt in order to be able to make those investments. So that's the only reason their free cash flow is negative. Their cash position falling a bit in these 2 years is because they're making huge investments. So there you have it, my friends. That overall, I think the management of Smith and Wesson's absolutely killing the game, my friends. I think $13.50 is cheap for this stock price. I think you could accumulate at this stock price relatively easy. If you had $1,400, you could buy 100 shares of this. Sign this up for DRIP, which is Dividend Reinvestment Program, and most dividend paying stocks have this available. But this one, based on history and the path that it takes and the management in this company's ability to use their cash wisely, it's just a smart investment, I think, over the long term. You could buy 100 shares now, or more. Obviously, I'm speaking from the point of trying to keep this somewhat affordable for the normal investor. I mean, $1,300 to $1,400 for the average American to spend on stocks is quite a lot, anyways. To be honest, if we're keeping it 100, but regardless, you really want to try to buy a minimum 100 shares if you can. I mean, it's not required, but if you can, right? But you could get $48 a year in dividends. And every year you could use that money to purchase more shares of this stock and end up over the years with more shares than you started with. So really, I will automatically recommend to any dividend stock that I put on this channel, you got to sign it up for DRIP, the Dividend Reinvestment Programs. I mean, Warren Buffett was a huge proponent of this, and the stock Coca-Cola. Warren Buffett makes billions of dollars in dividends a year, and I assure you that it didn't start at $1 billion in dividends a year. He had to use DRIP, the Dividend Reinvestment Programs, to build up his portfolio over time, just as Warren Buffett has explained in a lot of his writings and speakings, videos, etc. But there you have it, my friend. That's it for this episode. For the next finance episode, I think I'm going to try to do a little something different related to personal finance rather than the stock market, sort of around, maybe your own personal cash management rather than, a company's stock price. Is it a buy or a sell, et cetera, et cetera, et cetera. But I hope you guys are good. Hope you guys had a good week, because this will come out on Saturday. And remember, sign up for DRIP. Peace, peace, peace.